You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And saying how close I adhere to this is how you should grade me, not necessarily, as an alternative to the S&P or something else.
Yeah.
Tadas? I just want to make a couple of points. I've been reading the Charlie Ellis book, and he's obviously a big proponent of indexing. And it's interesting, he kind of talks about, the first half of the book is really about, it's kind of almost like a mini memoir. And he really goes back to the origin of the index fund 40 years ago, the S&P 500 Vanguard Index Fund, and talking about kind of the setting around then. And it was really passive back then, was kind of a slur. I mean, the idea that you would have a portfolio that wasn't actively managed, the idea, passive was kind of, that word was kind of thrown around as a negative. So it's interesting to me how you went from that to now where passive being kind of, in a certain respect, is almost a positive thing. So it's kind of so the idea of passive and active has kind of flip-flopped. But no, I think that's a really interesting point about, what is the market and what is that index? And I've used those charts in my class and showing kind of breaking things down, and I think it's a really kind of important distinction.
Didn't somebody just say a few weeks ago, somebody said that indexing is Marxist or something like that? I'm sure you saw that. It really does bring out these passions. Did you want to?
Well, there's an elephant here that we also need to talk about, and we're talking about passive and active, but there's there's this whole movement behind robo-advisement, right? And from my perch as a software company, we see the pain of many market decision makers out there, and the pain is reflected in actual where's the money going. And from 18 billion split among Vanguard and Schwab and Betterment and Wealthfront, these assets, there are some estimates at the beginning of the year that I was using saying that by 2020 there'll be $500 billion, but that's been far exceeded already, and they're calling it now $2 and $3 trillion by 2020. So this is a massive exodus of people marching with their dollars and their assets into this passive investing. So you've got to be able to understand what it is, and then you've got to be able to, again, from our perch, understand if that's where this huge wave of transfer and let's look at more evidence. I mean, you've seen in 2016 already 6 plus another 6, almost 12 billion of outflows from hedge funds moving out, and the rise of these of this robo-advisement suggests that's where this money is going, out of hedge funds. I mean, good luck trying to raise money with 2% and 20, and trying to call yourself a hedge fund and saying I've solved it, when people are actively they're moving their dollars because of a frustration themselves with their interaction with the market and their representative fund managers and their inner performance in the market. We had the worst open to the market in history in January, and that was enough to create enough jitters. And you've had a rebound that's been largely unparticipated in, and so there's a lot of pain behind moving your assets into a passive vehicle, where from our perspective, as a software company committed to finding alpha, we're committed to seeing, well, there's never been a better time to be active if the whole herd is moving into a passive environment.
But then you sort of wonder, could passive investing itself distort the market and make more opportunities for active investors? It's just an interesting way to think about it.
This whole distinction, we want to add clarity to this whole discussion by defining words very clearly. Active and passive seems like a very clear distinction, when the reality is that there's a lot of gray area between there. I would argue that, and Eddie, you probably know this better than anybody after having gone through your recent ETF construction, that any passive investor depends on active investors to make their products work. So an index fund, when you get down to the roots of how an index fund actually works, there's a lot of activity at the operational level of how any index fund is actually managed. Even if you just go down to the market maker level of how these things are actually being run, there's a lot of activity underneath the surface. These things look very passive to the end buying person or end buying investor, but under the surface, there's a lot of activity that makes that passive instrument actually operate the way that it can. So in a sort of way, the passive investor relies on the active investor to be able to achieve the low fees and efficiencies that they end up over the long term being able to take advantage of.
Right. It's a set it and forget it from the client's point of view, but there is a lot of activity in the management in order to adhere to what an index is. But imagine this. I mean, if you had said 20, 30 years ago that, hi, I'd like to offer you an investment vehicle and you will be guaranteed not to earn anything more than what this index is, but you can sleep and you will not earn anything less. I mean, that's a powerful heuristic that says of pain avoidance, to say that, yes, I will guarantee that I will not make anything more than this index or the market, but at least assure me that I won't do any worse. And you're not going to create wealth that way, right? And the markets don't really operate that way in its history, right? The markets are a way to, in a very liquid manner, be able to move in assets and take assets back out with an expectation of some growth. If you try to do that with real estate, you tie up those assets for 8, 9, 6 years. If you fancy yourself an angel investor, you would invest money into VCs or into companies and not see a return for 8 or 9 years. The market still serves that purpose of being able to move assets in and pull them out. But when you have this mentality of, well, I'm just going to set it and forget it and let someone else actively reach or achieve just what this index is going to do, I wake up every morning trying to solve that problem, to say, no, there's something more to the market here, and it just requires people to have better tools, better information. But, and then I think in the end, I don't want to foreshadow the end of this conversation or jump to any conclusions, but just, Cullen, what you mentioned about this gray area, that there is, I think, a spectrum where people will have an allocation across different styles, where you will have certain percentage of your portfolio that is, I want this tied to an index, and then I want this section of my portfolio managed by others, and then there's a sliver of the portfolio that I myself will actively manage, or I will choose a way to actively engage with the market. And that makes sense in my mind, in terms of how the world works. It's not black or white. It's not binary, 1 or 0. It's a wonderful shade of gray in which you have the spectrum of ways that you approach the market.
Yeah, no, I think that's a very reasonable point, and you just have to look at Vanguard. I mean, everybody thinks of Vanguard as this index powerhouse, which it is, but they're also a powerhouse in actively managed funds as well, and they have succeeded. I think there was an article just today or yesterday about kind of the success of Vanguard on the active side. And in part that's due to low cost, but in part it's been due to their process in managing, selecting managers and managing them. So I think, just within Vanguard, you see both active and passive. Again, kind of one sort of structure. But two, I had a couple other points I wanted to make. One was, you were talking about the mechanics of indexing, and obviously the biggest index that people know is the S&P 500, and you think, oh, that's the 500 largest stocks in the U.S. It isn't. It's selected by a committee. S&P has a committee of X number of people which actually pick the stocks that go into the S&P 500, the S&P 400, and the S&P 600. So, just right there, it shows you that there's more going on beneath the surface. And one last point I wanted to make was, I think absolutely the point you make is right. I think the reason why people are moving towards indexing, moving towards robo, is to remove kind of that lever of that one lever where they can make that mistake of either picking selecting a manager who underperforms, or timing getting in and out of that investment at a poor time that reduces returns. And I think it's almost, I think there's a behavioral aspect of that. People have kind of said, like you said, whoa, enough. Just give me the market, and I'll avoid trying to make any additional mistakes beyond that. So,
let me ask you guys a question. This is it's underneath the active passive, and it's just the basic question: is the market efficient? Is it kind of efficient? Is it somewhat efficient? Is it passingly efficient? Cullen, I know you've got to have thoughts on this.
Well, this is another, the whole idea of efficiency is something else that, according to academics, really the definition of has changed, over time. It used to be that this implication was that the market price is right. And over time, this has sort of changed to really mean that now all information is just priced into whatever stocks and bonds and other financial assets exist, which to me is sort of a meaningless distinction. If you take a bunch of monkeys and put them in a room and ask them to price a bunch of financial assets, they might price in information in a certain way and come to certain prices, and you could say technically that they've priced in all of the information that they're able to digest, but it's obviously meaningless. They're monkeys. So, when you compare that to what human beings do, they operate in actually a fairly similar way to monkeys or apes. We price in information, and whether or not we're pricing in that information in the right way is really unknowable. So whether or not all information is actually priced into the market, to me, it's very hard to decipher whether that has any useful meaning, any useful distinction at all, because we don't know whether or not that information is actually being priced in an intelligent way, or it could be that that information is being priced in a very stupid way, which means that, the whole concept of efficiency really doesn't have a very useful definition in the first place as we apply it.
It seems odd that for the market to be corrected by a trader, it needs to be enough incorrect. So the market needs to be inefficient if it's supposed to be efficient, or else no one's going to do the work to do it. There's no incentive to create it. So it seems that there are a lot of these problems right in the foundation of the theory. You guys have anything to add?
I would simply say it depends on your time horizon, right?
Zero Hedge
loves to say, at some point all returns go to zero, right? So, what time horizon are you talking about? And then it's a form of, what kind of advantage. It literally is every engagement in the market is done with the basis of, I know more than you, and who I've just sold this to is the sucker. And if I bought something, I know more than you, someone else is the sucker. But what's increasingly difficult, and the reason why you see this movement, of these assets into passive, is because there's a lot of people approach the market as mission impossible, in the sense that there are these flash crashes, there's incredible volatility, there's high-frequency trading, and it all leaves a sort of, I do not have the sense of control in engaging with the market that used to be there in previous decades, right? Previous decades where you could look at a chart, look at one indicator and say, well, this MACD tells me this, or the RSI, or this Chaikin analysis, or an Elliott wave tells me where I am. Those indicators were maybe created 40, 50 years ago before we had supercomputers on our desktops or on our, in our hip pocket. And secondly, it reflects the fact that these by themselves are not enough in order to gain an advantage. And again, another reason why I wake up every day is to put together, not to say that these indicators aren't bad, but they just won't serve the job in a silo looking at one chart, looking at one indicator. You need to take in an enormous amount of data, and you need to be able to process all that information. If you're going to have a hope of saying, I've reached a level where I feel confident about the information I have at this moment in order to make an informed decision. Short of that, you might as well put your money, someplace else and set it and forget it.
In terms of efficiency, I think the markets are probably efficient enough. I don't think there's stacks of $20 bills lying on the ground to pick up without taking on some risk. I think the entire, we haven't even talked about smart beta, and we might very well, but I think all the smart beta strategies you see, whether they single factor, multi-factor, all of those strategies, while they look great in a back test, they all undergo periods of underperformance. And so if you want to call that risk, then in a certain respect, even the things that you see in terms of potential for outperformance come with some risk. So whether that's efficiency or not, that's an argument that you can make. So I think that I think there's certainly that aspect to it. But I think I had actually, speaking of Zero Hedge, they had a chart from, I forget who it was. I had it in the blog in one of the Link Fests a couple of days ago, showing the ownership structure of U.S. equities over time. And you see, kind of at the far left part of the chart, you see individuals owning essentially controlling 90% of the stock in the U.S. market. And then you see over the last 50, 60 years, the market essentially has become more professionalized. You see mutual funds, you see ETFs, you see hedge funds, you see pension funds, all becoming much more significant owners of equities. And Michael Mauboussin, who is at Credit Suisse, has talked about this being kind of the paradox of skill. all of the players in the market have become more skilled over time. And so, so to that degree, I think you could argue, if you want to use that as kind of the benchmark, then I think you could argue that markets are, in a certain respect, more efficient than they have ever been. So,
well, let's get to whatever this debate is. The biggest factoid in favor of passive investing is you look at the record, and active investing does not have a very good track record, and I think even this year, particularly so. So when you get right down to it, what are the major factors? Why do active investors as a group, outside of fees, looking beyond that, is there a reason why they've done so poorly? Anybody?
Well, I mean, it's kind of hard to avoid the concept of fees and taxes in all of this, because it is the activity that creates the taxes and fees in the first place, that create the frictions that make it so hard for most active fund managers to beat an index that they're correlated to. I mean, when you take a large cap fund manager who is benchmarked to the S&P 500, you've got, I mean, let's say an index that's going to generate a 10% return per year, and this guy is trying to pick the 200 or 300 best stocks maybe inside of that index. So you've got something already that these 200 or 300 instruments are already very highly correlated to the 500 he's benchmarked to, and then he's going to pretend to be able to pick the 100 or 200 or whatever it is number that are uncorrelated consistently, that can overcome a 1% fee drag on average and the increased tax friction that he's going to produce by being more active than the benchmark. I mean, mathematically over time, being able to do that is just colossally difficult, because he's basically starting from right after the tax and fee friction is already incurred. You're looking at something like probably a 7 or 8% return maybe, and he's got to be able to pick the best stocks inside of that index that are going to overcome that hurdle already. It's just very, very difficult to do. So mathematically, tracking the index relative to buying the best pieces of that index is just mathematically very difficult to do consistently over time.
Do you have some thoughts on that?
Yeah, I mean, Garrison Keillor says, welcome to Lake Wobegon, where all of the children are, are above average. There's only one gold medal in any Olympic event that's awarded, right? So, as an active fund manager or even an active participant trying to beat an index, you are going to not, the large majority, won't do it, won't surpass that particular, obstacle or benchmark. So you have to look at those who do perform exceptionally well. What are the traits and practices? And be that a fund manager or be that an active individual market participant, you've got to look at what goes into their training. How is this their full-time effort? Is this what information are they looking at? And what kind of tools are they looking at? And you can to some extent try to replicate that, but it is difficult for a reason. If it were easy, we would all be living, in Lake Wobegon.
Go ahead.
You've artificially limited yourself to 20% turnover. And in respect, do you feel that, is that a binding constraint on you?
I don't feel that at all.
At all? Okay. You don't ever feel like you want to do 6 or change turnover?
If anything, I sometimes feel less.
Less, okay.
Which I know there would be a lot of day traders who would be horrified by that,
yeah.
But it's true.
Yeah. Well, the other thing that used to occur, in which, everybody likes to take Morningstar to task for, the nine squares, for the U.S. equity market styles. But there used to be the case that 20, 30 years ago, people would cheat. And so if you were a small cap manager, you used to compare yourself to the S&P 500 and you could get away with it for a long time. And so, or large cap managers would put a bunch into small caps or international stocks. And so that kind of going outside, now that for better or worse, managers have become more constrained within the strategy that they purport to follow, and that has essentially eliminated some of those alpha opportunities where you see an opportunity in another country, another market, a different size category, and I think it's taken some of that away.
And I know we've all seen things that funds that advertise themselves as S&P 500, even small cap value, they're radically different performing. You get
best example of all time. Bill Miller, Legg Mason Value Fund. This is a value fund that over the course of its history was never just a value fund. At times, this thing was an extremely high beta fund at times. So you know, a lot of this is just marketing that is sold to try to basically justify very high fees.
He was in internet stocks. I was at Legg Mason in the 90s.
Remember he crashed during the financial crisis because it was
value fund.
And this gets into a whole other debate is, you know, what is a value stock versus a growth stock? And who knows at what times a value stock is really a good value versus whether or not it's just a bad value, or is it really just a growth stock? It's just, you get into all these sort of gray area definitions that can be misleading.
Okay. I want to keep us on time, so we'll wrap this up. Guys, thank you very much.
Thank you.
Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.